Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq market site is Kaplan, co-CEO of Prometheum Inc., and we have Sid Powell joining us remotely, co-founder and CEO of Maple. We're here to discuss why regulation by engagement will lay the foundation for faster, more efficient market structure built for the digital era. It is great to have the both of you with us. Welcome to Trade Talks. And before we get into the conversation, Aaron, remind us of where Prometheum sits within the digital asset ecosystem.
Yeah, hi Jill, good to be back and thank you for having me. Prometheum is a public market and custodial infrastructure for digital assets. That entails through Prometheum ATS is an alternative trading system to publicly trade digital asset securities, and we do the post-trade side, meaning the clearance, settlement, and custody through Prometheum Capital, which was the first special purpose broker-dealer.
Yeah, and it sounds as if a lot of these TradFi names that managers are comfortable with are certainly within the description. And Sid, with Maple as well, it sounds as if you are using TradFi and DeFi and kind of moving along the digital capital markets. Tell us more about Maple.
Yeah, for sure, and great to be here. So the way that Maple works is we are an institutional lender, so we settle loans on chain. We take digital assets as collateral, and we've done about $5.5 billion in loans over the last few years. But we will lend to trading desks, institutions, and hedge funds against Bitcoin, Solana, and other large cap digital assets. But I come from a banking background myself.
Right, which is interesting, Sid, because I think what we're looking to do in the digital asset space is to create markets, not that they necessarily mimic TradFi, but have a lot of the same similarities versus an us versus them mentality when it comes to regulation and merging them in some ways to move the infrastructure forward to continue to foster institutional adoption.
That's absolutely right. I mean, what we want to do is provide a service that is familiar to customers who come from the TradFi space, whilst at the same time using the technology that we have at hand to kind of build and improve upon what was available before.
Yeah.
For example, stablecoin lending, you can settle anywhere in the world instantly. You can settle loans on weekends and after hours in a way that you just can't do using traditional banking rails.
Yeah, and I think, Aaron, you and I have discussed this before. It's more about integration and not necessarily isolation or labeling one or the other. Because at the end of the day, for us to successfully move along in the digital economy, these frameworks have to exist.
Yeah, I think overall what we're seeing is sort of a conflation between the securities markets and distributed ledger technology. And over the past, let's say, 3 to 5 years, we've seen new sort of ideas being incubated either in the blockchain side or the DeFi side. And what we're seeing with the integration of distributed ledger technology into public market infrastructure, what you're having there is basically the conflation between the two, such that the securities universe could sort of take the ideas that have been incubated in the DeFi space or the blockchain space and extrapolate them such that they could be used in the larger $100 trillion security space.
Well, I mean, at the end of the day, you want a clear path to compliance, because if you want to continue to innovate, you need to understand the guardrails in which you can operate.
Yeah, I mean, totally. I think what we're sort of seeing here overall is with the transition to regulation by engagement from regulation from enforcement, the idea here is to have a clarified path for compliance, whether that's for the actual cryptocurrency related activities or for the concept of digital asset securities, which is securities issued and transferred on a blockchain. Both have unique uses, both have unique applications, but the reality here is it's overall the larger conflation between sort of the distributed ledger technology universe and the securities markets.
Yeah, and Sid, I'm going to get your perspective when it comes to the lending environment within digital assets. Where would you say you are in terms of maturation within the space, and what's next for it? How do you expect it to continue to evolve?
It's a very good question. I mean, the original crypto lending product of dollar loans against Bitcoin is now a very well-trodden product. There's billions of dollars outstanding at the moment. And what we've seen over the last year or 12 months was a maturation where we saw other types of digital assets provided as collateral. So we saw a lot of demand for borrowing against Solana. And recently this year, with the interest and the speculation around either a SOL ETF or an XRP ETF, we've increasingly seen demand for these currencies to be used as collateral. And the other point to note is we're now seeing very well-established traditional finance players come in and look very seriously about lending against crypto assets. Just last year in July, you saw Cantor Fitzgerald announce they were going to be entering the space and lending against Bitcoin. So I expect to see more traditional players enter as the space matures.
So do you think part of that is because of how the underlying infrastructure and blockchains are evolving, as well as the interoperability between blockchains?
I think it definitely helps. If you look at the interoperability, what it allows for is more digital assets to be used as collateral. And increasingly, the other thing that we've seen is more stablecoin issuance. So you're now seeing neobanks interested in entering the space. PayPal obviously launched their own stablecoin last year. Ripple launched one at the end of the year, and we've seen even speculation that Revolut was going to launch their own stablecoin. But all of these are interoperable across multiple blockchains, and that allows, for one, it allows more liquidity for lending activities. And so I think it's overall very positive for the space. And the fact that you can use lower cost blockchains naturally helps customers because it just means, lower transaction costs.
Right. And Aaron, when you think about maintaining market integrity and investor protections, as we're learning how the digital asset class is going to continue to function and evolve, because it is a younger asset class relative to more familiar types of TradFi, why is maintaining market integrity, and not only the security from a trading perspective, but the cybersecurity perspective as well? Because there is there are a lot of vulnerabilities that do open up when you have more endpoints.
Yeah, I think the market integrity has to do with the larger regulated entities getting into the space. Because these are major entities either regulated under the banking and the securities laws, and they have fiduciary duties to their customers. So they have to ensure that there's proper checks and balances, proper market integrity, proper cybersecurity components when it comes to custody, clear and settlement and custody, from clear and settlement and custody, in order to make sure that they can properly participate in the space and such that they will not expose their existing business to potential regulatory risk. Right. So by having that market integrity, by ensuring that investors are protected, by ensuring that there's clear regulatory frameworks, the larger institutions can feel comfortable participating in the space and letting their customers have access to the different sort of products in the space.
Right. Well, why does it necessarily have to be either one or the other, or labeled its own asset class? Are there elements of digital assets that can fall under either equities or the CFTC's world, or do you think it needs to be in its own lane? I mean, is it necessary to rewrite the book when some of these regulatory frameworks, there's a lot of crossover there?
Yeah, so I mean, when you think about sort of digital assets, you have to bifurcate it into two major categories. We have cryptocurrencies, right, which essentially are a different means of representation of value in an underlying system outside of a traditional equity structure, basically network value, right? And that's one capacity there, and that's sort of being integrated into the larger regulatory universe, whether you see what's going on with the crypto task force and the like. Now, on the other side, we have digital asset securities, and digital asset securities are just securities issued and transferred on a blockchain. That's an equity, that's a debt, that's a structured product, that's a money market, that's a treasury, et cetera. And that's basically just the implementation of existing regulatory frameworks with a new technology underlying that. Because the means in which the assets actually issued via cryptographic token allows sort of the existing security players to take advantage of being blockchain native, meaning they have instantaneous settlement, they have capital efficiency, and it's just a question of these universes melding together. So it's that basically ensuring that the existing regulatory frameworks can handle what's going on in terms of the specifics of having those assets issued via cryptographic token, such that they could allow their customers to properly participate in the space.
Yeah. Well, Sid, what's your perspective on it? Having spent time in TradFi issuing a number of bonds, to the tune of $3 billion.
Yeah, and I was just going to add to what Aaron said. So you've got the idea of digital asset commodities, which would fall under CFTC. Then you've got the idea of digital asset securities, which would be under the SEC. But also, importantly, stablecoins, which are attempting to be just a digital representation of cash and used for loans, lending activity, settling trades and other transactions. And so that's almost a third category, which sits off by itself. What we've seen, though, is I think this year we're going to see a lot of progress on the stablecoin front. But I also expect that we will see some clarity around that distinction between digital asset commodities and digital asset securities, coming in the form of the market structure bill that's being talked about quite a lot at the moment.
Yeah. Well, it's interesting, Sid. I think sometimes when you're very like US or Western centric, you think of it in terms of value or how to hedge, but not necessarily the underlying infrastructure or the transactional side of how the digital asset
Yeah.
structure works, right? I mean, you're essentially building out what, not exactly, equity or bond infrastructure, but it's essentially the same theory behind it, that it's used to facilitate commerce and trade and a whole number of
That's
other activities
exactly
we don't think
right.
about day to day. Yeah.
That's exactly right. And I mean, the original idea for Maple, Jill, was that we would do tokenized bonds on chain. So my background was doing securitization banking and issuing corporate bonds, and the idea was, could we do something that kind of replicated that activity, but on chain, and in a way that would be much lower cost to operate and just more global in reach. And as we've seen the lending space evolve, obviously the sector that we pay most attention to is kind of what you'd call the debt markets or the credit markets. And I think this space in traditional finance, private credit is one of the fastest growing segments, and we're starting to see that excitement replicate on chain. And on chain, what I would call on chain private credit or just lending, and tokenized credit funds happens to be one of the fastest growing sectors that we're kind of seeing this year.
Yeah.
Now, in regards to tokenized bonds, it's interesting because one of the reasons that tokenized bonds was difficult is because that market infrastructure didn't exist. So in theory, you could have the bond issued, but if you can't trade, clear, settle, and custody with it thereafter, it's an illiquid product. It's sort of useless.
Yeah.
Right? So I think that's why the private credit grew initially, but the next step is these major securities moving on chain, whether it's bonds, equities, money markets, treasuries, et cetera, structured products particularly, because places like Prometheum that have the infrastructure, the ability to trade, clear, settle, and custody these assets once issued, empower the transition from these electronically issued sort of securities to digital securities, which are blockchain native, which settle faster, which basically have the capital efficiency and have better record keeping. And I think this also marks a larger shift from just electronic markets to digital. So it's really interesting because on one side you have the activities related to cryptocurrencies, but on the other side you have securities moving on chain. And both are major sort of opportunities. But when we look at the overall market, cryptocurrencies are a $3 trillion market. Traditional securities are $100+ trillion in the United States. Right. So the larger opportunity in some respect is digital asset securities, even though both present large opportunities.
Well, of course. I mean, your total addressable market and the opportunity is certainly to the upside, right? When you're trying to grow. Yeah.
Yeah, I was just going to add to what Aaron said. I think one of the challenges we've seen in the tokenization of securities coming on chain has been that a lot of the players who would transact in these assets, whether you're talking hedge fund managers or high net worth individuals, often have very good access to these instruments off chain, or rather in the traditional traditional distribution outlets. So one of the challenges we've seen is, how do you differentiate what's on chain and what folks like us and Aaron and Prometheum can offer clients, so that you really entice them to do this on chain rather than just calling up Morgan Stanley?
Right.
Right. And then it becomes a question of cost. Because why would someone choose, why initially did they transition from paper to electronic trading?
And that was my question, actually, to the both of you. From a portfolio management perspective and access and liquidity sourcing and so forth, is this a more efficient, cost-effective way, a more tradable way to manage a portfolio, or how you're looking to put together new types of digital funds and so forth?
So there's two components to that. One is the determination from the fund manager.
Right.
The other is the sell-side issuer. And from the sell-side issuer, imagine you could issue a product, let's say an S&P index that's issued cryptographically via cryptographic token, and it represents the same underlying index, right, as something that was issued electronically. Assuming that the cost is, let's say half the price. By definition, you would want to put your customer in the more efficient product, the less expensive product. And then there's also something called Regulation BI, Regulation Best Interest, where essentially a broker-dealer or fiduciary has the responsibility to put their customer in the less expensive product, assuming they both have access to the same underlying. So if you have a product that's issued cryptographically versus one that's issued electronically, and let's say it costs 30 basis points less, you have a fiduciary duty under Regulation BI to put your customer into that cryptographically issued product, assuming it represents the same underlying. And And that's why this transition from electronic to digital will occur. Because if the product costs less, and there's a fiduciary duty to put your customer in that product, by definition, it's a natural fit.
It's almost like indexing, like you have to own what's in the index. So it's just a natural progression of how the capital markets are look to evolve. I mean, Sid, it almost seems the next natural step. You almost have to be involved.
Definitely. And one of the other points to make is, I come from a banking background, and what we saw there is that within banks, there is what you'd call the OTC loan market, and this can take up to 21 days to settle. So it's very easy that's if a loan is being sold from one bank to another, and so it's very easy to make the case in certain assets like this, where there is much less liquidity in traditional markets, that there's a definite benefit to doing this on chain. And indeed, we can settle loans, within minutes from when a customer requests it if they do so on chain. So I think speed is really the key advantage that we try and highlight when we talk to clients, as well as the fact that in the type of lending we do, risks can be managed because cryptocurrency trades, of course, 24/7, 365 days a year around the world. So it's the type of thing where you can actually be, when I hate to joke about this, but whenever we have a period of extreme volatility, I joke with the team that it's never, lunchtime on a Tuesday. It's always midnight on a Sunday when the markets are really collapsing. But we've been able to, as a team, hop on calls and manage the risk and perform margin calls at times like, midnight or 1 a.m. on a Sunday when the volatility is really ticking up.
Yeah, I would imagine too, when you think about the lending and the fixed income spaces as well, those portfolios are incredibly sophisticated and more difficult to replicate and to, whether you're looking at laddering your portfolio, you have, different durations and so forth, and then just the liquidity of certain bonds, whether it's regional or otherwise.
Exactly.
It's nearly impossible for an investor to be able to replicate. So I guess any, basis point or any efficiency that you can grab, why wouldn't you, right?
100%, and certainly also a yield pickup. Like if you look at traditional credit markets at the moment, to get a yield north of 10% in the low teens, you'd be looking at, unsecured junk bonds. Whereas when you look at crypto-backed lending, you're able to get, at the moment, you can get loans that are over collateralized with Bitcoin, which trades 24/7, and you can be getting 10% or close to. And then if you're willing to look at other assets, whether it's Solana or XRP as collateral, you can start to get into the teens. Those types of products are not available from, conventional asset managers like Morgan Stanley. And so we really have to sell that point of difference. And I think that's also something that Aaron and Prometheum will do as their business expands, is we have to try and differentiate ourselves from competitors in traditional finance, before they start entering this space, because of course they have bigger balance sheets and more resources than startups like us.
Yeah, that's a great point that you make, Sid, because at the end of the day, when you think about scalability and more accessibility, it does, the larger competitors can make a dent in that.
Yeah, it'll be interesting to see how it plays out as the conflation between sort of the digital asset universe and the traditional securities universe occurs. I think what we'll see in the intermediate term is potentially some sort of consolidation in the security side to basically potentially put up a front against the crypto universe that is arguably coming to try to eat their lunch. And they're starting to be aware of it, and now that there's sort of a regulation by engagement approach, and the actual major institutions feel more comfortable participating in the space, I think you'll see more of a united and stronger front than what has existed historically as the crypto industry has grown sort of unimpeded.
Well, the market does what it does, and it always evolves. That's one guarantee you can make. All right, Aaron, Sid, appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.